Welcome to the Canadian Retirement Roadmap, where we help you navigate life before and after retirement with clarity and confidence. I'm your host, Patrick Briscoe, certified financial planner, certified executor advisor, and someone who's seen firsthand how good intentions in estate planning can sometimes lead to big problems. Today, we're diving into one of those well-meaning but risky decisions: adding your kids as joint owners on your property or bank accounts. On the surface, it seems like a simple way to avoid estate administration taxes, what most people call probate fees. And it makes life easier for your life and for your family. But as we'll explore today, that shortcut can open the door to tax complications, legal exposure, and family conflict. It starts with love and good intentions. A parent adds their child to a non-registered investment account to make things simple. But then life happens. The child goes through a divorce, a creditor comes knocking, or CRA decides that that arrangement is actually a bare trust that now requires annual trust tax returns. Suddenly, that simple plan has turned into a legal and financial mess. So in today's episode, we'll unpack why joint ownership seems appealing, the real risks that can come with it, and what you can do instead to protect your family and keep things truly simple, the right way. Let's start by understanding the motivation. Most parents who add their children as joint owners do it out of love and convenience. They want to make life easier for their kids and avoid what they have heard is a painful and costly probate process. And that instinct makes sense. Probate does sound like something to fear. It's complex, expensive, slow. But in Ontario, probate fees are 1.5% on estate assets above $50,000. So on a $500,000 estate, that's $6,750. It's not nothing, but it's far less than the potential legal or tax costs that can arise from poor planning. Still, the advice to just add your kids spreads quickly. A neighbor says that they did it and it worked out great. Someone at the bank mentions it as an easy solution. You read about it online, and before long, it feels like the normal thing to do. But here's the truth. It's not always safe or simple. And that's what we're going to talk about today. Let's dig into what really happens when you make someone a joint owner. First, legal exposure and intent. So I would consider this the first risk. When you add your child as a joint owner, the legal and financial outcome depends on one key factor: intent. If your goal is to genuinely gift half ownership, then your child legally and beneficially owns that portion. In that case, their share can be exposed to claims from creditors, divorcing spouses, or lawsuits. It's now legally partially their property, and you also lose partial control over that asset. Any sale, refinance, or change will require your consent. However, if you added them for convenience only, just to say help with banking, pay bills, or manage accounts, the law generally presumes that you did not intend to gift partial ownership. The Supreme Court of Canada actually has decisions on this called Pecor v. Pecor and Madsen Estate v. Saylor, and those established what's called a presumption of resulting trust. Unless there's clear evidence that you meant to give a gift, the law assumes that the asset still belongs to you. The problem is, often this intent is not clear. Without documentation or open discussion, families can end up in costly legal battles trying to prove what you actually meant. Courts often see siblings fighting over whether a parent intended a gift or was just adding a child's name out of convenience. So if you're considering joint ownership, make your intent crystal clear. Ideally, have that in writing. And if it's a genuine gift, understand that you're giving up ownership and exposing that share to your child's personal risks. If it's for convenience, document that you remain the beneficial owner to prevent any confusion, tax problems, or family disputes later on. The second risk is loss of control. Once your child's name is on the title, you can't make major decisions without their consent. Want to sell or transfer ownership? You'll need their approval. That might sound fine now, but consider what happens if you want to downsize, refinance, or change ownership for tax reasons, and your child disagrees or thinks you should be doing it differently. You're effectively locked in together. So if the relationship shifts, or if your child's own circumstances change, maybe they marry, move, or face financial pressure, their consent could be difficult or even delayed. You might also lose flexibility with future estate or tax planning, as the assets can't easily be restructured. So over time, what seemed like a simple name addition can become a barrier that limits your independence and adds unnecessary tension. If relationships change, you might suddenly find yourself without full control over your own asset, including the ability to decide how or when to use it for your own needs. Our third risk is taxes. When you add a child to an asset, the CRA looks closely whether you've changed the beneficial ownership, and if so, that can trigger what's known as a deemed disposition. It's a taxable capital gain as though you sold part of that asset at today's value. Even if no tax is triggered immediately as a result, your child may owe tax on their share of future growth. And one other thing that's catching people right now, starting in 2025, bare trust reporting rules make things even more complex. So let me break this part down. What is a bare trust? A bare trust is when one person's name is on an asset, but someone else actually owns it or gets the benefit from it. The CRA wants people to start reporting these kinds of arrangements, even if they don't earn any money from them. The goal is to keep things clear and transparent. So some family situations don't count as bare trusts, like when parents and children truly share a home that they both live in. But if a parent adds a child's name to an investment account or rental property just to make things easier, and the parent still really owns that asset, that could be considered a bare trust that must be reported on a tax return. So these kinds of setups now require what's called a T3 trust return, as well as a Schedule 15 every single year. And the Schedule 15 discloses the details and relationships of the arrangement. And missing these forms and filings can lead to fines up to $2,500 or even more if it's considered very serious. Okay, the fourth risk, family conflict. This one might be probably the hardest part. If one child is joint on an account and the others aren't, it can cause resentment or confusion. Was that asset meant to be shared equally? Was it a gift? When you're no longer here to explain, those questions can pit family members against each other. These kinds of misunderstandings can grow over time, especially when the intentions were never written down. Small doubts can become big disagreements, and what starts as a minor misunderstanding can turn into a lasting family rift. Sometimes even siblings who were once very close stop speaking to each other because they believe something unfair happened with mom or dad's money. In my experience, clear documentation and honest conversations while you're still here are the best ways to prevent those kinds of painful disputes. Make sure everyone understands what you intend, and if something isn't equal by design, explain why. That simple act of communication can protect not just your wealth, but your family relationships as well. Okay, on to the fifth risk, the loss of the principal residence exemption. So if you do decide to add your child to title of your home, this scenario may apply. If your child already owns a home, the portion of your house that's now in their name might not qualify for the principal residence exemption. That can create an unexpected capital gains tax down the road. The principal residence exemption essentially says that as long as you've lived in your home as your principal residence, it's a tax-free asset. So the appreciation of that asset over time, when you eventually sell or transfer it, the value is completely tax-free and you don't pay a capital gains tax. Here we're saying if you add a child to title, that rule may change, or it may be calculated differently. In other words, when your home is eventually sold, the part that belongs to your child could be seen by the CRA as an investment property rather than a principal home. This means that the gain on that portion could be taxable. So if they own 50%, then that 50%, the growth of it since they were an owner, could become seen as a capital gain for them, sometimes adding up to tens of thousands of dollars, depending on the value of the home. Many families are surprised by this one because they assume the whole property is exempt from tax under that principal residence exemption, since it was originally the parent's home. But if a child was added as a joint holder and they already own their own home, their share of the home will not qualify for that exemption. And that can create a big tax bill later that was unnecessary and may have been avoided if you hadn't added them to title. It's important to talk with a tax professional before adding a name to any real estate to understand how this exemption works and what could potentially be lost. All right, finally, our last risk we'll talk about today: government benefits and estate planning implications of adding a joint owner. Joint ownership can also complicate how income-tested benefits are calculated or how your estate is distributed. For example, certain government benefits or tax credits, like the guaranteed income supplement or old age security, depend on your total income and assets. They're income tested. If a joint account is considered partly your child's property, it can change how those calculations work and cause confusion about who actually owns the money and is receiving the income from those assets. In addition, when your will says that assets should be divided equally, but one child already owns something outright, your intentions can be easily thrown off. It can lead to an unequal inheritance or make it seem like one child received more than another, even if that wasn't your intention. For instance, should the asset held jointly with Johnny be treated as entirely his, or should it be counted as part of your total estate and shared among all the beneficiaries? This situation can also delay estate administration because executors have to figure out which assets are part of the estate and which are not. If the paperwork and intentions aren't clear, it might even create extra legal costs to sort everything out. That's why it's so important to make sure that your estate plan matches your ownership structure and that everyone involved knows what belongs where. So now that we've laid out some of the pitfalls of joint ownership, and maybe I've scared you out of it altogether, what can we do instead? Thankfully, there are ways to simplify your estate without adding new risks. So let's look at a few practical options and how they work in real life. One of the simplest steps is to name beneficiaries directly on registered accounts like RSPs, RIFs, and TFSAs. These accounts typically pass outside of the estate automatically, avoiding probate on those assets. Just remember that the beneficiary designations should be reviewed regularly and kept consistent with your will. Also, make sure you run it through your financial planner and accountant because those assets can be taxed differently, and you may end up in a situation where one beneficiary receives more on an after-tax basis than another. So even with named beneficiaries, you want to make sure that they're structured properly. And then for non-registered investments, some Canadians use segregated funds. These insurance-based investments allow you to name a beneficiary directly on the account where you otherwise may not be able to if it's a regular investment account. This can also help to bypass probate while offering potential creditor protection and other benefits like annuity payout options that you could discuss with your financial advisor. These types of products are not for everyone, as they can have higher fees and specific conditions, but in some cases, they can provide a very valuable peace of mind for those who are concerned about asset protection or privacy or bypassing probate. Another important tool is simply keeping your will and powers of attorney up to date. This ensures that your intentions are clear and reduces confusion for your executor or loved ones. Regular updates, even every 2 or 3 years, can prevent outdated information or unintended results. If you want even more structure or privacy, then maybe a trust would be worth exploring. Trusts can help control how and when assets are distributed, reduce delays, and sometimes protect against creditor or family disputes. They may also fall outside of the estate, bypassing probate. However, trusts do come with added costs and administrative work, so professional advice is essential, and usually these are not for basic scenarios. Finally, if you already have a joint ownership arrangement for convenience, document your intent very clearly, and ideally do that through a lawyer. Confirm whether you are the beneficial owner and whether the arrangement needs to be disclosed under the new Bare Trust reporting rules that are coming into effect for the 2025 tax year. Clear documentation and good communication will go a long way towards keeping your estate plan organized and your family relationships intact. As we near the end of this episode, here's the bottom line. Avoiding probate can seem smart, but shortcuts often cost more in the end. Probate is one of those topics that gets a bad reputation because it sounds like a long, expensive process, but in reality, it's simply a way to confirm that your will is valid and that your wishes are legally recognized. It protects your executor, ensures the right people get what you intend, and provides a clear roadmap for banks, lawyers, and the courts to follow. A bit of good planning today can prevent years of confusion down the road. By keeping your documents current and naming the right executors, you can also make settling an estate smooth and respectful. These small steps can save you money and reduce stress for everyone in the long run. Probate isn't really the villain that it's made out to be. It is often a small price to pay for the peace of mind, legal clarity, and family harmony that it can create. Think of it as a bit of an investment in certainty. The fees you pay for structure, security, and fairness. Having a properly probated will can also help prevent fraud and disputes, giving your loved ones confidence that everything is handled correctly and in accordance with the law. With the right advice, you can keep things simple and safe. Surround yourself with those professionals like your financial planner, estate lawyer, and tax advisor who can help you make informed decisions that reflect both what you want and what's best for your family interests. I'm not saying to avoid ways to bypass probate, but if you're going to do so, just make sure you have solid advice backing up those decisions. If you found this episode helpful, be sure to follow or subscribe to the Canadian Retirement Roadmap podcast, where we explore practical topics that help you retire smarter, avoid costly mistakes, and live with more confidence. For resources, jump over to bayswaterwealth.ca/podcast. There you'll find guides and checklists to help you plan your estate and retirement the right way. I'm Patrick Briscoe. Thank you for listening, and I'll see you next time on the Canadian Retirement Roadmap.
Trademarks owned by Investment Planning Counsel, Inc. and licensed to its subsidiary corporations. Investment Planning Counsel is a fully integrated wealth management company. Mutual funds available through IPC Investment Corporation and IPC Securities Corporation. Securities available through IPC Securities Corporation, a member of the Canadian Investor Protection Fund. Insurance products available through Patrick Briscoe.